all eyes are on the election. It's coming up. It's a month away, and some investors are actually getting jittery over whether the outcome will impact the stock market. There's a study by T. Rowe Price that found from 1927 to 2023, the S&P 500 performed this way. Presidential election years, 11%. That's 24 observances, by the way. Non-presidential election years, the other 72 years, 11.6%. All years total, that's 11.5%. So the S&P average was up around 11%, elections or not. And what's more, markets typically see less volatility during election cycles. So should we depend on history when it comes to looking at elections, especially this election? What are you telling clients that are maybe calling up a little concern right now?
Well, I mean, I can completely understand their concern, with the election this year. I do think probably one of the most dangerous things that I can hear from somebody say is this time it's different. I can think of a situation where I was doing an event. I had a gentleman who came in after a workshop and had let me know about 2 years ago that he had moved all of his money out of the market just because he was really frustrated with this current administration, and he was going to, sit it out in cash until the election was over, meaning that he was going to wait for this 2-year time frame. And the unfortunate thing, looking back, is that the last 2 years he missed out on, incredible opportunities because the market has had strong growth these last 2 years. And so, thinking this time is different is something very dangerous. In fact, if we look at the markets in whole, we've had really 2 back-to-back positive years in the market. This year's not over with, as well. But using history as a guideline, S&P has experienced roughly 15 positive periods where it's had 3 or more consecutive positive gains when you look at the history. So, history doesn't always repeat itself, but it's not saying that next year is going to necessarily be a bad year in the market. There's multi-year positive streaks that are common during, bull markets. You've got the longest span I think of in the 9 years from 1991 to 1999. Another streak that we had was from 2003 and 2007. The thing that I would say is that, though, when you look at market corrections, and so you look at COVID or 2008, or you look at most of these other market cycles, losses can happen fast in the market, and it's usually something that's unexpected that comes up. So with the markets at record high, don't worry so much about the election. I would say just make sure that you have a downside risk management system in place. It may not be a bad idea to protect some of the profits that you've had if you've had some strong growth in the market, and don't lose sight of your long-term goals. So I would say history in election cycles doesn't mean a whole lot for market returns, is my opinion.
Well, I would add to that, the Federal Reserve is starting to cut interest rates, which generally means that the markets respond positively to interest rate cuts. And I know one of the topics for today is, when do you sell your home in retirement? Well, has it been good for a person to want to buy a home in the last 12 months? Interest rates have been fairly high. So I think the cutting of interest rates are going to make more people consider borrowing. It's also going to get investment capital flowing, maybe more so into the stock market, because the election cycle, those 11 to 11.5% numbers are real. And so you want to keep your options open. But I would also say that this is a main reason why you need a qualified financial advisor as a part of your team, because we can have meaningful discussions about how to look at your investments and what do we do when the market takes an unexpected tumble. Because a lot of times it's not about when to get out of the market. It's, if you get out, when do you get back in? And a lot of people from 2008 never got back in, and that makes those losses permanent.
It does actualize those losses, and it compounds, between the market being down and then, the potential loss when the market does rally and go back up. Here is the thing: over the course of your retirement, you're going to see multiple elections. You're probably going to see a couple market pullbacks, and you're going to see all sorts of different wild cards that could give you a little bit of pause. Now, we are an emotional species; feelings are valid, but if you have a plan in place that says, yes, I know that these things are going to happen, but we've accounted for it thanks to something like the Retirement Team Action Plan, it can hopefully give you a little bit more confidence so that where you can tune out that financial noise, tune out that political noise, and be able to, a novel thought, I think, enjoy your retirement. But you have to take those first steps and set up a time to speak with someone like the team at America's Retirement Headquarters. Start developing that Retirement Team Action Plan. 419-794-3030 is how you begin. That's 419-794-3030. Or you can go to the website, which is arhq.com.